Alright, so let's talk about 8 target strategies that work in all time frames and all markets. And targets are very, very overlooked. And if you don't have a good target strategy, you will never make money as a trader. In trading, 95% of all the people spend all of their time and all of their energy on trying to improve their entries, on trying to time better entries, or trying to find the best way to get into a trade. But no matter how good your entry is, if you don't have a good target strategy and if you don't know when to exit your trades, it will not work and you will never make any money. So let's get going and let's get into number 1. So the first one is the most simple one. It is also what I often recommend to new traders. It's the fixed reward to risk ratio. And what this means is very simple. So once you have identified your entry point, then the second point is you find your stop loss price. Then you measure the distance between your entry and your stop loss. And in this example, it is 7.25 points. And then you just multiply the stop loss distance by either 1, 2, or 3 to get a specific reward to risk ratio. So if you want to have, for example, a 2-to-1 reward to risk ratio, you use 2 times 7.25, which is 14.5. Or if you want to have a 3-to-1 reward to risk ratio, you set your target at 21.75. Or if you want to trade with a reward to risk ratio of 1-to-1, you just simply use the same stop loss distance for your target as well. This is a very good approach, especially for new traders, because it eliminates a lot of guesswork and you don't have to worry too much. However, at the same time, you have a consistent target approach already. Number 2, swing and support and resistance areas. So once you have identified your entry point, you simply look to the left. What is the next closest support and resistance level? Other people and other traders maybe go for an option of what is the second closest support and resistance level. And then you place your target based on the next major support and resistance level or just the major swing point that is on the left. However, what is really important here is that you never put your target below the level. You always want to make sure that your target is a little bit in front of the level, because very often the market will not reach those support and resistance areas. Sometimes it's also not 100% clear where is now really the horizontal support and resistance, especially if there's wicks and volatility around the levels. So you want to make sure that you account for that and for this uncertainty factor, and you put your target a little bit ahead of the level. Number 3, pattern projection. So what this means is, for example, we are looking at a horizontal inverse head and shoulder like what we have here. And then we just measure the distance from the high of the pattern to the low of the pattern. And then we project this distance into our favor, into the trade direction. So here you can see this is the pattern height from the low of the pattern to the neckline in this case, because it's an inverse head and shoulder. And then we simply project the same distance into the top. And then you simply put your target at the pattern projection. This is not the same way we use the fixed reward to risk ratio, because obviously in the fixed reward to risk ratio you would project it based on the stop loss size. Here we project it based on the pattern distance. Number 4, higher time frame moving average. So looking at this chart, and this is especially valuable in Forex trading, because Forex trading is a mean reverting market. And what is the one thing that is always true and always happening in this chart? The price is trading around the higher time frame moving average. Forex is a mean reverting market. What is a mean? It's a moving average. So what this means is that the market would always keep coming back to the moving average. Obviously, nothing works 100% of the time, and sometimes the moving average will come a little bit in your favor, or maybe a lot more in your favor to catch up with price, but the price will trade around the moving average. So in this example, we are on a 30-minute time frame, and this is the 4-hour moving average on the 50 period. So you can see it moves in those zigzag lines because it's coming from the higher time frame, and it adjusts every 4 hours based on the higher time frame price action. And if you are trading into the moving average, in this example, this would be more of a reversal or a counter trend trading approach, because you would then base your target based on the moving average, so you keep trading back into the moving average. And this is how you would place your targets. Very important, because the moving average will shift with time. The longer you are in the trade, the more the moving average will move. So you have to keep adjusting your target as well based on the moving average distance. Number 5, Fibonacci extensions. So once you have identified, and this works especially well for breakout approaches, so once you have identified your breakout reversal, you look for the first A, B, C pattern. So you have your A around here, your B, and then you see the C is here, the 50% Fibonacci level. And then if you're trading with the trend after the breakout, maybe even a pullback approach, then you would base your targets based on the Fibonacci extensions. Usually, when you use Fibonacci extensions as your target, you generally go for 138 or 161. Those are the very common ones. 200 and 261s are not often used as a target because it's very rare that the market will reach those levels, because it takes a huge trend to actually get to 200, let alone 261. So your holding time will be significantly longer, and also your win rate will drop a lot if you go for those huge levels. However, another alternative could be that you use 138 for your first target, maybe you scale out 50%, maybe 75%, whatever, and then you just try to keep your position open and let it run to the 200 or 261. Number 6 is based on the trend rider. This is the indicator that I've developed. The link to that in the description below if you want to get it. It's available on MetaTrader 4, MetaTrader 5, and also on TradingView. And the trend rider, as the name suggests, it is used for trend trading, and it works especially well for breakouts. So I have marked 2 breakouts. So here we have a head and shoulders pattern, left shoulder, head, the right shoulder. We have a neckline, and on the breakout, this is when you get in, you can see the trend rider also gave you a signal. And as long as the background color then stays red in case of a downtrend and in case of a short trade, you would generally stay into your trade, because this is what the indicator is doing in the background. It's calculating, is the trend still going, or is it time, or is the momentum reversing? And so this is here then the first time the trend rider background color turned white, so this may have been a good way to exit your trade. Then you have a triangle or a wedge pattern, you have a breakout, the trend rider turns green, and here's then the first time that the background color changed to white and gave you the signal to exit. Again, link in the description below. Number 7 is a time-based approach. So time-based approaches can often be used in combination with other target approaches. So you may use, for example, a fixed reward to risk ratio, or maybe support resistance target approach. But you can also add on top of that a time-based approach. So let's assume you are a day trader and you don't want to hold any trades overnight. So in addition to your fixed reward to risk ratio approach, you would also have an end of session target, or rather a stop loss. So by the end of the session, no matter where the price is, you would cut your trade so that you are flat overnight. Or if you're a swing trader, you exit all your trades over the weekend, or before the weekend rather, so you don't have any over weekend exposure. And number 8 is a trailing stop loss approach. This can also be used alongside with other approaches, especially when you're going for a higher reward to risk ratio. This makes sense to establish. And generally what you do here is that you add a moving average. In this case, I have used the 50, but you can also use a 20, a 30, whatever. And then you would just trail your stop loss behind the moving average. Very important here is that you don't put your stop loss right at the moving average, but you always give it some room. You can see the market will often come back into a moving average to test it. So you want to make sure that you're not taken out by premature pullbacks, but you want to make sure that you give your trade room to breathe, and that the stop loss is not too tight, so you're not suffocating your trade. And then once the market has fully closed on the other side, or maybe once there has been a significant dip through the moving average, that's then where your stop loss is hit and you are out. So those are the 8 target approaches. Let me know in the comments which you like most. Let me know any number from 1 to 8. I would look forward to hearing from you. Let me know how you like this video, and then you will hear from me very soon again. Happy trading!